Welcome back to Daily Digests for Thursday, August 6th, 2026. The financial landscape saw a sharp shift in monetary policy expectations today. CME FedWatch data reveals that market-implied odds for a September Federal Reserve interest rate hike jumped to 56.7%. As benchmark indexes consolidate near record territory, investors are adjusting to fresh signals that the central bank may not be finished tightening policy. The catalyst behind this repricing stems from internal Federal Reserve dynamics and stubborn inflation data. Reports indicate that 3 out of 12 voting members explicitly dissented against holding rates steady at the recent FOMC meeting. With annual inflation holding near 3%, Federal Reserve Chair Scott Bessent is reportedly prepared to move forward with a preventative rate hike at the September meeting if forthcoming economic reports show continued strength. Fixed income markets reacted quickly to the hawkish shift. Treasury yields across the curve moved higher, retesting recent highs as traders unwound bets on early rate cuts. Higher borrowing costs are beginning to weigh on equity valuation multiples, creating headwinds for broad stock indexes after their recent rally to all-time highs. Shifting to corporate earnings, Latin American e-commerce and payments giant Mercado Libre delivered exceptional top-line results. Second quarter net revenue reached $10.2 billion, representing 50% growth year-over-year and marking the first time the company has crossed the $10 billion quarterly threshold. Strong consumer engagement across key markets like Brazil drove the record revenue performance. Behind the revenue milestone, Mercado Libre's fintech arm, Mercado Pago, expanded rapidly. The company's total credit portfolio grew 75% year-over-year to reach $16.4 billion, supported by robust credit card issuance. While operating income declined 17% to 6.7% margin due to aggressive growth investments, investors are focusing on the long-term flywheel of user monetization and ecosystem expansion. In corporate credit markets, persistent high rates are exposing growing stress across investment-grade issuers. Over $100 billion of investment-grade corporate bonds, including debt issued by tech giant Oracle and automaker Stellantis, are currently trading at credit spreads typical of junk bonds. Investors are increasingly concerned that heavy borrowing to fund AI data centers and EV restructuring could trigger a wave of credit downgrades. Private credit and trade finance are facing fresh collateral concerns. Major commodity trading houses, including Vital and Cargill, have suspended transactions with iron ore trader Radiant World, following allegations of invalid invoice collateral, affecting Jefferies trade finance funds. This credit stress aligns with recent warnings from investor Michael Burry regarding a potential credit cycle downswing as equity valuations hit record highs. Helping cushion macro headwinds, U.S. Treasury Secretary Scott Bessent is executing a tactical shift in debt management. The Treasury announced it will shift its net financing mix from -21% in the second quarter to +61% in the third quarter and 58% in the fourth quarter. By leaning heavily on short-dated T-bills rather than long-term bonds, the Treasury is limiting duration supply and providing liquidity support to broader financial markets. In consumer tech earnings, sector leaders are proving the power of distribution scale. DoorDash reported quarterly results showing it maintains approximately 65% of the U.S. food delivery market share, more than double its closest competitor, Uber Eats. DoorDash's dominant market position continues to drive operating leverage and defend its premium valuation against sector newcomers. Meanwhile, Uber Technologies reported that its monthly active platform consumers reached a record 208 million across its global mobility and delivery ecosystem, representing 15.5% growth year-over-year. Management highlighted that Uber operates at nearly 600 times the ride volume of autonomous vehicle competitors like Waymo, demonstrating that massive consumer distribution shields core network platforms during technology transitions. Cross-asset flows delivered significant market impact today. A coordinated U.S.-Japan currency intervention pushed the Japanese yen from 163 to 158 per dollar, triggering a massive short squeeze against record spec short positions. Simultaneously, S&P 500 call option volume eclipsed a record 4 million contracts, driving dealer delta hedging and supporting market breadth alongside capital rotation into financials and healthcare. Relative strength analysis highlights clear divergence across key subsectors. The ratio of the SMH Semiconductor ETF relative to QQQ Tech Index shows bearish divergence, signaling that chip stocks are temporarily lagging broad technology. Concurrently, base and precious metals are breaking out to new multi-month highs, signaling commodity accumulation alongside defensive equity rotation. Looking ahead, investors face a two-sided market environment. While corporate earnings and Treasury liquidity provide underlying support, rising September rate hike probabilities and historical mid-August weakness suggest volatility may pick up. Maintaining balanced sector exposure and watching key support levels will be essential as upcoming inflation data shapes the Fed's next move.